Welcome to an episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Chad Ackerman. After starting to invest passively in real estate in 2018, Chad built multiple income streams, liquidated his 401k, and ultimately left his W-2 career. He co-founded Left Field Investors, which grew into one of the nation's fastest growing passive investor communities and was later acquired by Bigger Pockets and then becoming Passive Pockets. Chad is also the founder of CARE, Chad Ackerman Real Estate, where he coaches successful professionals who are new to passive investing. And with over 30 years of corporate leadership, he combines a real-world business experience with personal investing lessons to help his clients create time freedom. So, Chad, thank you so much for coming on the show today.
Absolutely, Charles. We really appreciate you having me on and looking forward to the conversation.
So you have a very interesting background prior to getting involved with passive investing, which I think every guest kind of has a little bit of their own take on how they got into real estate. But can you tell us a little bit about how you, how you got into passive investing in 2018 and a little bit professionally about what was that road that led that W-2 into that?
Yeah, I wrote a blog that talked about it, and I said, it's a tale as old as time that I met I had a friend that was at work, a young lady who said she was looking into multiple income streams, and it struck with me. I'm like, oh, I should look into this too. This is a good idea. So it was, girl meets boy, boy hears about multiple income streams and goes crazy, basically is what it is. But I love the idea. I started in real estate. I started buying right away for an engineering firm way back right out of college. And then got out of it and went into the corporate world, was doing the W-2 thing for 25 plus years. And literally was a conversation with a coworker that said that they were trying to do income streams and liked real estate. I'm like, yeah, I understand real estate. Let me look back into this. And I started chasing the shiny objects. This was like 2015. It took me 3 years to invest in my first deal. Because I was looking at everything. And I started out down the route that a lot of people do, looking at single family work and looking at flips, I even kind of tried to start a wholesale business with a group of guys, and just nothing seemed to click. And it was always cumbersome to me of how am I going to scale while I'm in my W-2. So I never got behind it fully. And I found I was on Bigger Pockets at the time, like a lot of people are. I found a local meetup through Bigger Pockets then that was here in Columbus, Ohio, and attended it. And it was very active real estate and oriented. But the last one I attended, the guy that founded it, or one of the founders of that meetup, was Jim Pfeiffer. He got up and talked about how he left his job through passive investing in real estate. And I'm like, that's the thing I'm looking for. So I met him afterwards, introduced myself, found out we lived in the same suburb of Columbus. We got together for a beer, and it really took off rolling from there. That I'm like, this is what I've been looking for. I love the real estate benefits that it provides, but I love the passive side of it as opposed to being the active user that is chasing tenants and termites and toilets and everything else. So when I learned all the benefits, especially the tax benefits, then it really set me running into this space.
So one of the things that I realized when starting to invest in real estate many years back was that, the people that I've seen that did really well with it, it was something where they had a lot of money, and then where they became active or semi-active type investors where they had a property management company. The people where I saw what did like one or two deals and got burnt out were like the single family or small multifamily. And the people that I saw, like they were like attorneys and they bought like a 20-unit building, they had professional management, or they were in it all day, like they had their own crew flipping houses. And then they were like, oh, also I have, 30, little houses, 3-family houses or whatever like this that we kind of manage after hours or whatever with my team. And those were like the two ways I really saw people successfully like get into really multifamily that wasn't on the passive way. Because if you go in, you're going to burn yourself out, like you said. I mean, and making $200 a month, which is not true, because once that HVAC goes out, which it will, or something happens like that, I mean, you're back to square one, you know what I mean? For that whole year, maybe part of next year.
Exactly. Yeah. No, and honestly, I mean, this is why we started Left Field. This is why I pulled CARE together when we sold Left Field. It's just to get out and educate people that, hey, there's this other avenue. Single family work is great. Small commercial, being a GP and operator yourself, all that's great. There's a ton of education out there to teach you how to flip houses and be a single family operator. There's a ton of information to teach you how to be a GP and an operator with multifamily, larger commercial, but there was nothing really out there to teach you how to be a limited partner in those commercial deals. And that's what we did with Left Field, was just try to build a network of people that were like-minded, educate ourselves, educate other people that came to find this, and grow and learn off of it, because you couldn't find it anywhere else. So we did it with Left Field for a long time. We sold Left Field. Now I want to go back and do it with Care to introduce new people to it. I built an onboarding program so I could walk you through step by step what you need to know to get you in this business and get you educated on it, just to help show you there's another avenue here to go.
Yeah, it makes perfect sense. It's when I'm speaking to a new passive investor, someone that's joined our group, just like getting emails and stuff like this from us. When you talk to them initially, you'll know kind of what their passive investing experience is before really asking them, because the questions will be much more, I guess it'd be much more structured in their presence. And you might speak to a new LP and it's here, it's over here. They're asking questions about stuff that they might have had on a single family house. And they're kind of missing, I think, some of the major points, which is it's for us to educate them, right? But it's also one of these things is that you can see that someone that comes through that's been a little seasoned, what they find is important and what they want, boxes they want to check initially and for their notes is greatly different from the new LP that hasn't gone through like Left Field or working with you.
Yeah, no, I think you're spot on. I the biggest one, and it was the same for me, was learning about bonus depreciation and really understanding the value that had versus the single family market. And maybe you could 1031 and that's great, but you have that short window. Understanding the bonus depreciation side, I literally had to hear it probably 4 times before it really sunk into me. Of like, oh yeah, I understand the depreciation. That's great. But I didn't until somebody really sat down. And what it took is I literally shared my underwriting of a deal with somebody, and I had a line in there for 30% of tax costs. And they said, well, why do you have that in there? And I said, well, you got to pay tax on this. And they're like, no. Understand the bonus depreciation side of this. You can wipe that number out. And I'm like, that's a 30% number. You're telling me I can get rid of this number? And they're like, yeah, understand the whole benefit of the bonus depreciation. It really can affect the numbers that you're doing on the passive side that you can't get on the active side. You can't get out of the stock market. So that's something I try to bring it up multiple times with people that I coach, because I assume they're like me and it doesn't totally sink in the first time of like, you hear it, but you don't really appreciate what it's saying until you really dig in and understand that it changes your numbers significantly.
That makes perfect sense. It's definitely something you have to hear over and over again because you don't know exactly how it does. And we'll touch on it a little bit, I think, when speaking to new investors, but it's something where it gets kind of like convoluted with active income. And I don't want to go down that road where they're like, oh, we can offset all this. So you really have to have like your own training on just that, where you're just not bringing it into
Agreed. Yeah. And that's not the first thing to say. I use it as a way of saying, hey, I want to help you understand the true differences between active and passive. And the biggest is related to, well, one, how much time you put into this, but then the second is the tax benefits. So I tell people, go get educated on it, but understand there's value there. Then we talk about everything else, but then we get back into bonus depreciation again. And are you sure you understand what's happening here? And let me scale it out for you to give you a good image of what it's going to look like as you invest in these deals and why it's important. But it takes a little while. But once people see it, I think it becomes a real game changer for them.
Yeah, for sure.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So let's talk a little bit about what you've got going on, Chad, with your passive investing. So explain kind of your current investing strategy, the asset classes you focus on, because as I understood, there was a lot that you invested in, and then kind of like the types of deals that you've really been focusing on since becoming a passive investor, and what you're actually looking at buying now, because there's so many things you can invest into passively just in real estate. And then there's all these other kind of hybrid, like alternative investments inside of syndications as well that you could invest into.
There is a plethora, it seems like. And that is part of my strategy then, is try not to distract yourself. I want diversity, but I want diversity in a narrow lane in from an asset class standpoint. I've decided to try to stay in 4 or 5 asset classes to not get distracted by all the alternatives and all the Johnny-come-latelys. And I don't want to be a guinea pig on a lot of things that are new. So I like to watch. So I've picked 4 or 5. I am in multifamily, commercial triple net lease, retail commercial, or retail triple net lease, industrial. I like the triple net lease models. And then I'm also in mobile home parks as well. And I've tried to stick with those being my core. I'll look at self-storage a bit, but that's changed quite a bit over the years here, that it's not quite as lucrative as it used to be. So I'm not in any right now. But those are the ones I try to stick close to. And, I talk to operators every week. I see all sorts of different asset classes popping up and what seems hot and what might be the next thing. Marinas is a big thing right now, it feels like, of having its day. But I'm just not ready to commit to jump in yet until I see some more, which may mean I miss out on some of the upswing that a new asset class has. But I want to mitigate my risk by not jumping in and being part of the testing phase of it. My discipline is what I try to focus on, which isn't always easy, but it's be okay with, 15 to 20 to 25% IRRs. Don't go clamoring, trying to grab the 30, 35% IRRs, because the risk is just higher than I'm willing to take on it right now. So I try to pause myself on watching too much of that.
I have a mentor, he calls it joy of missing out. And
yes, exactly.
It's much easier to say than to do, but it is something. I hear marinas, and really just as a side thing, the amount of CapEx that must go to, you know what I mean, any type of marina on water and saltwater, whatever it is.
You got to assume something that scares me right there. Oh yeah, I agree. I like the multiple income streams that they have, but yeah, there's a risk involved there with how much of a battering is everything taking while it's there too. So
true, for sure. So just quickly, you were talking about self-storage not being as lucrative. What have you seen? Just like an oversupply of it coming in? I mean, they're so easy to build once you have the land. What were you finding?
Yep. And I think it's the ground ups, or there's a couple groups that are doing conversions from like old malls or Kmart's or big box stores that have closed that they can pick up. I think there's some value in that, but I still really like the model that they have. But yeah, it seemed like, go back 5 years ago, self-storage was kind of the high growth area, the asset class that was out there. And it seems like it's gotten kind of saturated, that a lot of the bigger entities bought up a lot of the mom and pops. And it used to churn out some really big numbers. I still think self-storage is a very safe asset class to get into. It's just not going to have the equity bump like it used to have anymore, because it's gotten saturated. The market's kind of calmed down in that space, which again, it's still a good investment to get into. It's just not that skyrocketed asset class anymore that it was at one time anyway.
Yeah. No, I do like the idea of them repurposing, like you said, big box stores, because the one benefit there is it's not 10 miles outside of town. It is something that is central. You know what I mean? So that's one thing you have. And a lot of the infrastructure is already done. It's not like you need to, it's not like going from, when people talk to me about motels or old hotels into apartments, completely different than just putting up dividers inside an old warehouse. You know what I mean? So
yeah, build some steel boxes in there. And I love the model. One group out of North Carolina that does this, they mentioned too how generally they're buying Kmart's that have been closed for 10 years or something, however many years now, but they have huge parking lots for most of those. Well, self-storage doesn't need it. So you have assets you can sell off once you have that property as well. They had one home run they hit that they sold a corner of the parking lot off to, I think it was McDonald's, paid like 800 grand for the whole thing, sold the corner for 700 grand. They're in for next to nothing. And then it's so cheap to build the boxes inside. I'm like, yeah, that's what I want to go find and invest in. And they buy and hold. They don't really turn them over. So you're sitting on cash flow for a long period of time with those. Now, it takes a couple years to get to cash flow because they got to build everything, get all the development done, and then rent it up. But once it gets going, it seems like it's a really good model. And you get, pretty easy returns on it because you don't have a whole lot of capital into it to begin with. So
yeah. And the other thing too is that if you have any type of moat of your business in self-storage, it's really the distance, I would say. You know what I mean? They're all pretty safe. I mean, your stuff's not going to get wet. We understand all that, but it's just if something's very close to where you are, it's going to be something where you're going to pay the same versus going to a new place that's 15, 20 minutes drive out.
Exactly. Yeah.
So Chad, what does it mean to be an active passive investor?
That's a great question. I love that phrase because we call this passive investing, but there is an active side to it. And what I coach on and preach about all the time is your job is all the work you have to do up front, all the due diligence to decide where you're going to go invest. And it's betting on the jockey, not the horse. It's really getting to know the operator, and trusting them to be able to invest with them. Then look at their deal and understand, does their deal fit into your model? And do you like their performance and so forth? But the active passive investor, the logic behind that is you've got to do all that due diligence up front to make sure you're comfortable with it. Because once you write the check and send it to the operator, that's really when you become a passive investor in that deal. And there isn't a ton of recourse that you have once you write the check. If something's going awry, there are some avenues that you can make some changes. You can instigate changes anyway, but it's very difficult. It's not a simple thing to do that as an LP, limited partner. So it's doing all your work up front, because once you do sign that check, your kind of work is done and you're along for the ride at that point. You're giving up control, which I was okay with. I don't want to lift the hammer. I don't want to do the tenants and so forth. So I'm okay with that, but it's on me to make sure I'm reading that deal and that operator well before I send them any money, because I'm out of options almost once I send the money over to them.
So we're just talking about kind of your focus area asset classes. I mean, how important is it for any investor, any passive investor that you're coaching that's following your advice to really narrow in on that 1, 2, 3, 4 different asset classes that they really focus on? Or is it better, I think, or is it a spray and pray, which I think a lot of passive investors have that in their mind, which I've realized over the years that really focusing down into different couple different asset classes that you're doing passively is really the best route.
Yeah. Well, you should have some understanding, some knowledge of any asset class you're getting into. And so then it's just the scale of how much you can learn of having 15 different asset classes. That's an awful lot to keep up and understand what the economy is affecting on those asset classes, and politics and trade and and tariffs and everything else. So it's giving yourself the ability to stay engaged in understanding the asset class is very important. What I coach, the second session I take you through, first one is just kind of introductory, teach you about the space. The next thing I do is we sit and talk about goals and strategy. And it's so important to know that up front before you dig into this, because your goals are going to align to certain asset classes. And understanding what your goals are, and then by relation from that, you're going to understand what asset classes to get into. It cuts out on some of the noise, because you can ignore a lot of the chatter that will end up in your inbox as you get started on this. People find you then, that they understand you got money to invest. They track you down. And everything's going to look exciting when it comes in your inbox because they're marketing what they're selling, what they're trying to get you to invest in. So it all looks pretty. Understanding that buy box, what you're really trying to do, your strategy first is so important. I didn't do a good job of this myself. The first investment I got into was a 17-story building in Cleveland, Ohio. That was an office space that they were going to rip down, not tear down, but gut it and then build it back into residential. And I didn't realize at the time I was really looking for cash flow because I was looking to get out of my W-2. Well, it didn't make sense to get into this deal if I'd known what my goals were, because it was going to take 2 or 3 years just to go through the rebuild process, let alone rent it and then be able to get to distributions and get cash flow. So it's so important to me that I try to coach. It's exciting, but pause before you go running down the road. Let's talk about what your goals and strategies are, because that's really going to feed what asset classes to get into.
Yeah. So around like 2022, I saw a huge transition, mainly with multifamily operators. Obviously, we're multifamily people, investors, so it's something that we really follow. But it was something that I was having partners or people I was working with, or people that maybe I passively invested with that were value add operators just 12, 24 months before that, now becoming developers. And it was something that we never did any development. It wasn't something that I feel confident enough about doing, did some past investments with it. But it was something that, how do you approach a trusted operator, maybe in asset class A, when they enter asset class B? And how does that, you should know, I imagine, if they're trusted, that they're probably not going to steal your money here, but that doesn't mean that they're going to be able to complete the deal to somewhat similar to what they're expecting.
100%. It's, I don't want to call it a red flag, but it is a cause for further investigation anyway. Being a value add operator is there are so many different regulations and processes you got to go through to be a developer instead. So, and we see this a lot. To your point, like over the last 4 or 5 years, we see a lot of multifamily people that maybe got into self-storage as well, or some other asset class altogether, whether it was ground up development of multifamily still or a complete different asset class. I don't mind an operator trying to diversify and have a portfolio of offerings for their investors that is broad, but it is a concern. Anytime I see that, I usually, the first thing I look at is, what is your team? Did you hire a bunch of people in your scenario that are development aficionados that have been doing development for a long time? So you're not the operator necessarily doing all the strategy around this development project when you've been a value add operator all this time. So have you pulled a team in that's going to really kind of help out? And, is it one person? Is it an entire team? Is it an entire group? How in depth did you invest your own business into this new asset class that'll make you tangible and be an expert in it? Not you maybe specifically, but your team, that I can trust that more. And if it's not there, then I'm more of we talked about this, getting over the fear of missing out or the joy of missing out being the case. Sit and watch. Wait, there's nothing says I have to invest in that new offering with them. Let me watch you for a year or two, depending on what the asset class is. Let me see that you understand the asset class and you're getting educated on it and so forth. Then I can make my decisions on it. But so it gives me pause when I see an operator try a new asset class. I don't usually want to go in their first offer. I want to see how they manage it, and knowing it's just going to be different. They're going to have to approach it differently. So I want to see how they react to it. Then I'll go do maybe the second offering if that's the case.
I remember I was reading Stephen Schwartzman, which is a co-founder of Blackstone. And in his book, I guess in the late 80s, they were buying some apartment buildings down in Texas. They didn't know anything about it. And the amount of pages in this guy's autobiography about finding the right people that he was putting on this real estate team. Like him and his partner are like scouring the globe for these people. They're going here, they're going there, they're finding them at dinners in New York, all these places to put them on their team. They're letting the person like remote work from Chicago or something crazy like during the 80s, which is like unheard of, just like so he could put the right team together to get into that asset class. They weren't going to conferences and learning how to be, multifamily investors. And they were like, let's get the best people in, let's give them a ton of money, and then let's raise money for it, as we always do. And I was like, that's such an interesting way compared to people, I think, on this, where they're like, oh, we're learning it as we go. And no one wants to hear that. You know what I mean? And, and no one's going to put big money behind it. That's why they're getting big $100 million checks and stuff like that from LPs.
Yeah, no, 100%. I applaud an operator trying to diversify, and I get the strategy for them, knowing the economy is going to wreck your asset class at some point in time. All asset classes go through different economic situations, so all are going to have impacts. Having diversity in the GP's portfolio, helping their business stay a little more consistent and have ebb and flow, hopefully different ebb and flows for different asset classes. I could totally appreciate it. I want to see that you've done something to accelerate your go-to-market strategy with it, not, hey, I'm going to learn on the job over the next, because they've been through it once. They created an asset class to start with and learned all the bumps and bruises that they had to go through for it. I want to see that they're getting there quicker by hiring the right people for the next asset class that they might try.
So let's take like a thought you had earlier about red flags that passive investors maybe should be aware of. And you touched on one of them. Is there any other ones that kind of come to mind? And we'll talk about real estate passive investors because that's what the show is based around. But yeah, kind of go down that hole and see exactly what you would see as common red flags.
Yeah. The first one I always get leery of is the glossy marketing, the high numbers, the high RRRs or X returns. The shiny object really comes into play with this. I always coach, beware the good marketer that isn't a good operator. And it's hard. Don't get, covered over your rose-colored glasses on because it looks so intriguing. So be cautious. Be okay with the tried and true. And, tried and true is still doing. If you can still get 15, 16, 18% returns, there's nothing to complain about in that space by all means. So be leery of those that are the big, hey, whale hunter kind of things. The next thing more kind of aligned to the operator that is a big concern of mine is communication. I try when I'm meeting a new operator personally, I try to inundate them with questions, emails, phone calls to see how they respond to me before I've given them any money. Knowing once I give them money, they probably are going to be harder to get a hold of with questions if they're poor about answering questions when you haven't given them money, when you're vetting them. So I purposely try. I don't want to waste their time with goofy questions. I have tangible questions I'm asking, but I try to come up, especially once I look at a deal and something's out of my buy box, out of my ranges. I want to ask them about what's your reason. I would expect it to be in this range and you're out of the range. What is the logic behind the scenario to hear their underwriting process, how they approach a deal, and just purely how they respond to me and my questions as I ask all these things. So communications is a big element of it as well, because if something's going wrong, I want to know that they have a good dialogue with their investors so I know what to expect, if things go sideways, because we've had a lot of things go sideways over the last few years.
Yeah, for sure. Yeah, one thing I've heard on calls with the potential new investors is that they ask about when something negative happened, how that communication was, how long it took for that communication to come out, what it looked like, and then also what was the communication on an asset being sold, so they could prepare, like we started this conversation off with tax planning, which I thought was, wow, these are really good questions from seasoned past investors and stuff that, these are a really good like FAQ for people that maybe are starting out, because these aren't things you really ask about. You know what I mean? Because now it takes preparation. If you've invested into something and, hey, next week we're having a capital call, much different than, hey, looks like in 4 months we're going to have to be doing a capital call. More information will follow, blah, blah, blah. Now you're like, okay, so got to put together some money, got to start like realizing, going over what's happening here. Because now we're reinvesting into this business that we already invested into.
I think the capital call is a great example of seeing good communications from operators versus bad. I'll be the first to say on the podcast, not all capital calls are bad capital calls. There are scenarios that a capital call can be worthwhile for the investment and be a positive thing. How that operator communicates that capital call describes their plan for the money, whether it's just, you're in a fund and, hey, I'm calling in more capital that you didn't initially put in because we're ready to go buy another asset class, or, hey, something's gone haywire and we need more capital to keep the deal floating. But here's what I'm going to do. Here's my strategy. And here's how it's going to help save the deal. At the end of the day, I'd rather get something back out of my investment that maybe that capital call helps save some return versus losing everything altogether. But it really gives a good chance for an operator to communicate with their investors effectively when a capital call scenario pops up. It really kind of made or broke some operators over the last few years because of all the different things that were going haywire that, if they were transparent, open, and said, here's what I'm going to do, here's what I missed, here's how I'm correcting, that built a lot of credibility for me of, okay, I get it, you're human, who had global pandemic on their bingo card, when they were doing all this. So I get it. Let's adapt to it. How are you adapting? What are you learning from it? Those are really effective communications to get from an operator that makes an LP feel safe. And then I'll, potentially reinvest a lot quicker with them in those cases.
So you talked about the communication portion of it. What are some other maybe best tactics for mitigating risk as a passive investor that you have found?
Diversity is the first and foremost to me. I preach diversify in asset class, in operator, and in geography. Asset class, so like we talked about, the economy won't hit all asset classes at once, hopefully. So if the economy dips in one area, hopefully you got another one that's doing well that can help out. Diversify by operator, that should be a simple one for people to understand, of don't put all your eggs in one basket of one operator, that if something goes wrong in theirs, your portfolio's gone, kind of thing. And then geography, don't buy everything in your neck of the woods in Southwest Florida or Southeast Florida, because what if a hurricane takes everything out and your whole portfolio gets a hit from that. So be smart about where you're spreading your money around. And then I used the tactic. I liquidated my 401k. My goal was to invest minimums with as many different operators as I could. One, to meet many operators and start to get that relationship growing even more. But then just to spread it around. So I didn't run that risk of, what if this operator didn't plan things right? I don't want to give them all my money. I want to spread it around. So those are a couple big ones that I tend to preach on pretty heavily as well.
So let's break that down a little bit more. I touched on that and you just did. I mean, some might find that as an aggressive response to passive investing by liquidating your 401k to passively invest. But you teach a lot of people. I mean, do you have coaching students who have followed you in this path? I imagine you don't suggest it to them, but
I don't.
and you had a great plan for kind of when you went over what you just said about why you did that, which makes perfect sense. You're diversifying, you're meeting people. Did that go as planned? What would you have done differently maybe when you had done that?
Great question. By all means, I say this is a plan, not the plan when I talk to people about that. So I don't preach it. I do get a lot of phone calls about that, though, of people that find out because they're thinking about doing the same thing. The biggest thing I learned from it, that had I had it to do over again, I might have changed slightly. There are ways to reduce some of the tax that gets on that if you take out a little at a time, as opposed to I ripped the Band-Aid and took it all out, paid all the tax, paid the penalty, was done with it, kind of thing. So there are ways to kind of pull money out there. I had a self-directed IRA, which a lot of people use too, but I wanted the cash flow. I wanted to be able to use it. I didn't want to be able to have to put it back in. But I coach on, I've not had anybody try it that I've talked to, that I've worked with specifically yet, because honestly, it comes up in the goal discussion of like, well, what are you really trying to do? And I haven't found anybody that was in my same specific scenario. I was divorced at the time, so I was single. And so I didn't have another spouse to get acquainted or approval from and so forth. My kids were late teenage years, so I kind of had everything structured for them for college and everything else, that I could take a flyer on this and try it out. So it's very specific, and everybody's goals are unique. So I absolutely talk about it with people, but I have not come across a scenario that I would ever suggest it to somebody yet. Because generally the people that I'm running into, they're still pretty happy with their W-2. They're willing to stay in it for another 5-6 years while they're building cash flow. But I usually coach, well, if you're willing to stay in your W-2 for a while longer, focus on equity then. Don't focus on cash flow to start right now, because you've got cash flow coming in from your job. Build your equity and have more wealth to play with then. So when you're ready to flip over to cash flow, you've got that much more money to play with and be available to replace your W-2 and so forth. So I haven't hit that scenario yet. It probably will come around if I stay doing this long enough. Somebody will come up and be in a good spot to be able to do that. but I haven't hit that yet. So I tell the story, but I say, hey, don't follow my footsteps necessarily. Let's talk about what you're doing. Where are you right now? And let's see what makes sense for you.
Yeah, I appreciate you explaining that. One thing kind of kills me with financial advice on the internet is people will say one thing and then they make it as it's for everybody, which is everybody's got different goals. Everybody has different people that are relying on them, different parts of their life and stuff like that. So it's kind of really just for a really small portion. When they give financial advice, it's for specific people that are pretty much in their same spot, which there might not be many. Yeah.
The one thing I will say that is global that I will say I would talk to about with everybody is pause and let's talk about your goals. Because I can't give you good advice and help you through if I don't understand where you're going to go. And if you can't explain it to me, then we need to spend time on that. What are you really trying to get out of this? And I say, treat it like your will of create it for what you feel like you need today. As something changes in your life, then pivot your goals to match what your changes are. So if you're in a W-2 and everything's going great and your kids are kind of plugging along and everything's good, well, then focus on equity and let's just build your wealth while you're in a good spot. And then say you lose your job. Okay, well, now let's look at maybe pivoting something to some cash flow. Are you willing to get back into another W-2? Do you think that's feasible? You're going to try something else? Do you want to start your own business? There's lots of things that could happen that could influence this, but let's worry about what your goals are today and get things started based on it. And then pivot your goals as your strategy changes down the road.
So Chad, kind of as we're wrapping up here, what would you say are your main factors contributing to your success as a passive investor over these 7 years now?
Yeah, the number one to me has been getting involved with the community. We started Left Field Investors and we got a bunch of like-minded passive investors together. And I learned so much from all these different people that joined our community. Now it's Passive Pockets. I encourage people, we encourage people, go find multiple communities to get into because it's just that much more opinions you're going to get. Because there isn't a ton of education out there, I got educated through the community and other people's experiences. And I still think it's a valuable way to go through it. I encourage people to seek out communities all the time because there's a lot of value in that. I learned how, when I met Jim, and at that meeting, I asked in the Q&A of his presentation, I said, how long did it take you to decide that real estate was your thing, that you decided that was it, and when you left your W-2? And he's like, that's a good question. He said, I think it was about 5 years. And I said, and he had spent the whole hour talking about all the mistakes he made along the way. I said, I want to meet you then, and I want to do it in 3 years instead and learn from your mistakes. And I left my W-2 about 3.5 years after I met him. So I was pretty close to my goal with that. So find somebody that's a couple steps ahead or a community of people that you can learn off of, because you only have so much money to play with. You want to be as smart about it as you can. Get as educated as you can while you're doing it.
It also makes sense too, when you're vetting operators, meeting people one-on-one or maybe on a phone call that you have some sort of familiarity with, maybe through the community. They're going to be a lot more upfront with you about what there is. It's much different if you don't know who you're talking to. Right? They're not selling it, but also, they don't know if this is going to go back to the operator, what it might be. And if you're talking to them one-on-one, it's something where finding them through a community like that, you're going to get a lot of what the information that you really want to get when you're vetting that operator.
Agree, 100%.
So Chad, thank you so much for coming on today. How can our listeners learn more about you and your business care?
Yeah, so easiest thing is to go out to my website at chadackermanrealestate.com, all one word, or find me on LinkedIn. I'm out on LinkedIn quite a bit too.
Awesome. Well, Chad, thank you so much. We will put those links into the show notes and looking forward to connecting with you here in the near future.
Great. Thanks, Charles. I appreciate it.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.